All right. Now, before we look at this question, we can have an overview of preparation of a cash flow statement. Well, we have two methods of cash flow statement preparation. We have got the indirect method, and we also have the direct method of cash flow statement preparation. In the examination, the direct method is not very common. The one that is always common is the indirect method. Now, in the indirect method, we'd always have three sections. Your cash flow statement will contain your cash from operating activities. It will contain the cash from investing activities, and will have the cash generated from financing activities. So those are what you will first of all have your profit before tax, and then you make adjustments for those for the cash that was generated from those activities. Generally, in a cash flow statement, what we are looking at, well, we have got the income statement, we have got the statement of financial position. Those ones, they give us an overview of the activities within the company. They do not go into details to say, well, this was the cash inflow and this was the cash outflow within the company. So to get that information, that is now why we do preparation of a cash flow statement, to show the movement of cash in and out of the company. Now, in the indirect method, just like I've said, we'll have our profit before tax, then we make adjustments for cash from operating activities, cash from financing activities, and cash from investing activities. I'm going to explain what cash from operations, investing, and financing contains. But just difference between the indirect method and the direct method is that in the direct method, to get to our cash flow from operations, there is a process that will follow. So if I just write here, direct method of cash flow statement preparation. Look at the direct method of cash flow statement of preparation. So to arrive at our operating activities, so we'll have operating activities, and for our operating activities, we'll have cash received from customers. We'll have our cash received from customers. We'll have our cash received from customers. We'll have our cash paid to employees and suppliers. Cash paid to employees and suppliers. And then again, we'll have our cash generated from operations. Cash generated from operations. We'll have our tax. We will have our tax. And this will be able to give us our cash flow from operations. Cash flow from operations. So generally you'll realize that cash received from customers, we will add that. Cash paid to employees and suppliers, we'll subtract that. When you do that, that will give us the cash generated from operations. So cash generated from operations is actually a working of the above. Let me underline this. So here we'll get our cash generated from operations, and then we'll subtract tax. We'll subtract our tax. We will subtract our tax, and this will give us the cash flows from operations. This will give us the cash flow from operations. So the output of that is cash flow from operations. Yeah. This is supposed to be subtracted. The cash paid is supposed to be subtracted. Yeah, we subtract that. So that is how we compute for the first part of the cash flow from operating activities in the direct method. We have cash from financing activities and cash from investing activities, which remain constant as in the indirect method. The only place that we change is cash from operating activities in the direct method, and this is how we are supposed to do it. So the other ones remain constant. The other ones remain constant, and of course, that is what we are going to look at. That is what we are going to look at now. When we get to the indirect method, so in the indirect method here, just like I said, we are going to have our three sections. We'll have our profit before tax, and then we make adjustment for cash from operations, cash from investing, and cash from financing. What is contained in each of these three parts? Well, number one, we have our cash from operating activities. If we copy from what we have done from the operating activities under the direct method, what we realize is that the cash flows from operations activities do contain of cash receipts from customers and cash disbursements to suppliers, employees, and any other overhead expenses. Generally, that is what is contained in the cash from operations. It contains of cash receipts from customers and cash disbursements to suppliers, employees, and for any overhead expenses. That is what we have in the cash from operations. So in the cash from operations, we look at, well, what are the activities that are involved in the day-to-day business of the organization? Those day-to-day income generating activities within the business. That is what we look at when we are looking at cash from operations. When we go to cash flow from investing activities, here we normally look at the company's investment in long-term assets. So we look at purchase or disposal of long-term assets. Was there any purchase of long-term assets? What was the amount that was used to purchase this asset? Was there any disposal of a long-term asset? If there was a disposal of a long-term asset, what was the cash generated out of this disposal? So that is what we look at when we get to investing activities. But it doesn't stop there. The investing activities extends further and look at, again, the purchase of any marketable securities, by the company. These include some things like bonds. It includes some things like stocks. So when the company purchases such marketable securities, we also say that the company has made an investment, because at the end of the day, it will be earning some dividends and interests. Yeah. So the purchase of the marketable securities like bonds and stocks, we also count it in as a cash from investing activities. And then we have cash flow from financing activities. And our cash flow from financing activities will contain four major things. Cash flow from financing activities which will contain four main things. Number one is receipts for increases in principal loan amounts. Allow me to write these ones. Cash from financing activities. Number one, we have receipts from principal loan amounts. We have receipts from principal loan amounts. Number two, we have disbursements for reductions in loan amounts. Disbursements for reductions in loan amounts. Actually, let me add something here. Receipts for increases. Let me just make this adjustment. Receipts for increases in principal loan amounts. Yeah, receipts for increases in principal loan amounts. Disbursement for reductions in loan amounts. Disbursements for reductions in loan amounts. Number three, we have receipts of increases. Receipts of increases in what we call paid in capital. Paid in capital. And finally, number four, we have disbursements for dividends. Final number four, we have disbursements for dividends. So these are the main areas that we look at when we come to cash flow from from financing activities. Generally, cash flow from financing activities deals with if we say we have got loans and issue of shares. When the company acquires a loan, it is acquiring a financing, or in other words, it is acquiring capital to finance its activities. You want to make certain investment, but you do not have enough capital for that. You take a loan. When the company issues shares, it is issuing shares to raise capital for a certain project that it wants to do. That is to finance its activities. So number one, we have receipts for increases in principal loan amount. That means when the loan is taken. And we should take keen note that we are talking about principal loan amounts. We are talking about the principal loan amounts. So it is only the principal loan amounts, not the interest on that loan. The interest on that loan, normally, you will classify it under operating activities, because the argument is that the interest from a loan is not really a financing activity. The interest is a fee that you pay so that you can use that loan. It is yes, exactly. It is more of what do we say? Financing your loan, something of a sort. So it is not directly an investing cash flow. So you can either classify it as a cash flow from operations,
yes,
or you can classify it as a cash from financing. But generally, it is not part of cash from financing. But IFRS requires that you can either classify it as an operations or as a financing, so long as you maintain consistency. Yeah, so that is the treatment for the finance cost. That is the treatment for the finance cost, which is the same as the interest. You can either treat it as an operations or as a financing, so long as you maintain consistency in your books. Then we have number two, disbursements for reductions in loan amounts. Disbursements for reductions in loan amounts. Disbursements for reduction in loan amounts here, we have now paid our principal loan that we took. So our loan have reduced. So how much have we paid that loan? Receipts of increases in paid-in capital. Receipts of increases in paid-in capital. And generally, we know that paid-in capital, this is simply the amount of money which you pay for you to acquire a share of a company.
Yeah.
Yeah, that is the paid-in capital. So receipts of increases in paid-in capital, that means when more people invest in the company's shares, when more people invest in the company's shares, how much have they used, or rather, how much have we raised from issue of such shares? Then we have disbursements for dividends. Well, the people have invested in the company's shares, they have to get
Dividends.
Their payback, which is dividends. Yeah, they have to get their payback, which is dividends. So that is what we look at. That is what we look at there. And that is an overview of what the cash flow from financing activities will contain. So those are the three sections that we have in the cash flow statement from the indirect method, and that is how it varies from the direct method. Actually, just like I said, the difference is just in operations. All the other activities remain the same, and we are going to see how we look at cash flow from operations in the indirect method of cash flow statement preparation. So let's look at this question. Let's look at this question. Now, the question says, let me increase the font a little bit. So this is BDA 2022 DEC question 24. It says Bermuda Limited presented the following financial statements for the years ended 30th of June 2021 and 30th of June 2022. We have the statement of profit or loss for the year ended 30th June 2022. We have the line items there for the income statement. We are given the statement of financial position as at 30th of June of 2021 and 2022. Further, we are told the following. Number one, property, plant and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended 30th of June 2022, we are told that items of plant during the year ended 30th of June 2022, items of plant and equipment which originally cost 40 million shillings were disposed of, resulting in a loss of 6 million shillings charged in admin expenses. Okay, these items had a net book value of 28 million shillings as at the date of disposal. Number two, we are told that depreciation charge for the year ended 30th of June 2022 was 43 million shillings. And number three, 50 million shillings of convertible loan stock was converted to 50 million ordinary share capital at par during the year ended 30th of June 2022. Required, prepare the statement of cash flows for Bermuda Limited for the year ended 30th of June 2022 as per IAS 7 statement of cash flows. Good. So that is what our question requires us to do. So let's go through it. So we can first do our workings, or we can just start directly. So where do I do it? Let me do it here. Let me do it here. This is Bermuda Limited. Bermuda Limited. Statement of cash flow. So the year ended when? 30th of June, 2022. Yeah. Okay, so these are shillings in millions. These are shillings in millions. So I'll have here shillings in million, and as well here shillings in millions. Shillings in millions. Shillings in millions. Well, so just like we said, you're supposed to start with our profit before tax in the indirect method, profit before tax. So we start here with our profit before tax, profit before tax, profit before tax. And our profit before tax is, we get that from our income statement.
Yeah.
Here it is, 114.
114, yes.
Yeah, that's our profit before tax. That's our profit before tax. Then for our profit before tax, we will adjust for. So this is where we start with our cash generated from operating activities. Cash from operating activities. Cash from operating activities. Our cash from operating activities. Now, let me give you a short form that you will use to master this thing, cash flow from operating activities. For your cash flow from operating activities, we are simply saying that these are the day-to-day income generating activities for the organization. What we have under cash flow from operating activities, what you simply need to do is to simply do this. You simply need to dial. You simply need to dial God's number. You simply need to dial God's number. For what? For food. Else you rest in peace. Else you rest in peace. So you say, dial God's number for food. Dial God's number for food. Else rest in peace. Dial God's number for food. Else rest in peace. Let me write it here. Yeah, that is what you need to have. And once you are done with that, you are done with everything to do with cash flow from operating activities. I'm going to tell you how to make any other adjustments. So you just write that acronym moving down. Dial God's number for food, else rest in peace. Now, D, What does this stand for? This stands for depreciation. The D is for depreciation. Now, anytime we talk about depreciation, we must always think about its two close sisters or brothers. That is, number one, amortization, and number two, impairment. So if we talk of depreciation, we need to think about both impairment and amortization. So the I is for impairment. And then the A is for amortization. Now, depreciation is for our tangible assets. Impairment and amortization is for intangible assets. So impairment will be specifically for goodwill, then amortization will be for other intangible assets like copyrights. Those are also assets. They undergo amortization. So all the other intangible assets will undergo amortization except goodwill, which undergoes impairment. The other tangible assets, they undergo depreciation. They undergo depreciation. Now, from that, we have got the L. We have the L. And the L here simply stands for the loss. This is loss
on disposal.
On, exactly. Loss on disposal of PPE. Loss on disposal of PPE. Or if it is in case of a consolidated cash flow, then we are going to talk on number one, loss on disposal of PPE, and number two, loss on disposal of a subsidiary. If it is a consolidation, then of course the G is for a gain. The G is for a gain. So we'll have gain on disposal, gain on disposal of PPE, or as well gain on disposal of a subsidiary in case of group. In case of consolidation, we'll have that gain. And then from here, we have our F, and the F is finance cost. This is finance cost. Finance cost. F, finance cost. We have our R. So when we do everything here, we are going to get what we call cash flow. Sorry, it's supposed to be up to this point. When we do all this, we are going to call what we call we're going to get what we call cash flow before working capital changes. That will give us the cash flow before working capital changes. So once we do that, we go to the working capital changes. Our capital change, our working capital normally has three main items: receivables, inventory, and payables. Hiyo unaendanga unachukua kwa statement of financial position directly. Receivables, investments, and payables. By extension, the only thing that we can add here is prepayments and accruals. So this is receivables. This is receivables. This one here is inventory. Then this over here is payables. This is payables. So when we are done with this, we shall have finished what cash flow from operating activities entail. The only thing that we need to add here is once you are done with this, you go to your income statement. Then check on the section for profit before tax. Here, profit before tax. We will draw our line here. Then we check up above if there is anything that is here and we have not included here. we'll add it. But it has to be in exclusion of, number 1, cost of sales, number 2, administrative expenses, and number 3, distribution expenses. So anything from profit before tax going upwards that is not distributing expenses, that is not admin expenses, that is not cost of sales, we will as well adjust for it here. All right, so let's make our adjustments. The first adjustments that we need to make is for depreciation. The first adjustment that we need to make is for depreciation. So for our depreciation, this was given directly. I think I read it somewhere. Yeah, it's here. Additional information number 2, we are told that depreciation charge for the year ended 30th June 2022 was 43 million. Yeah, so we are going to have our depreciation being 43. Depreciation is 43. Depreciation is 43. And then we have impairment. We have impairment. We have impairment. So allow me to merge the two now that we have known the format. So I'm just going to merge the two. I'm going to say, okay, amortization stroke impairment. So I'm going to put the two together. And for our amortization or impairment, for our amortization or impairment, we will look at our intangible assets. We look at our intangible assets in the statement of financial position, and our intangible assets for property, plant, and equipment. We see that in the year 2022, we had 264. We had 264. Not really. We had
40.
50, yeah?
Or 50, then. So we began with 40, then 2022 we were at 50.
2022, 50.
2021, 40, then 2022, 50. So there was a movement.
Is this really the question? I think there is some interchange here in terms of the years.
Okay.
40, 50. Yeah, this should be 2022. And this one 2021. Yeah, that's what we should have. Let's have 2022 and then 2021. Yeah, let's make that adjustment. We just change the years. So if we look at this, in 2021, we had 50. Then in 2022, 40. 2021, 50, and then 2022, 40. So that is an impairment of 10. Because the value reduced from 50 to 40. So we have an impairment of 10. So for our impairment of intangible assets, we'll say this is equals to, we'll have 50 here minus 40. We'll have 50 minus 40. We'll have 50 minus 40, and that gives us 10. Or if you like, you can do for it a working somewhere. You can do a working for it somewhere. If you'd want to include a working for it, you can do for it a working somewhere. So just in case you were to do for it a working, let's say that will be our working one, and you're going to call it amortization. You are going to call it amortization. So for this, you are going to do your amortization for goodwill. You are going to do your amortization for intangible assets, and you will have here the balance brought down. And what is our balance brought down? 50 is our balance brought down. And then we have the balance carried down. Can leave a space there.
40.
Then we have our balance carried down. It is
40.
40. Yeah, here, 40. So we have a balance brought down of 50 and a balance carried down of 40, which means that the reduction from 50 to 40 is our amortization. So it will be 50 minus 40. So this is amortization. This is what we call amortization. Yeah, right. So that's fine. The next, we go to, what do we have here next? We have the loss on disposal of PPE. So we check during the period, was there any disposal of PPE? Yes. Additional information number 1, we are told that property, plant and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended 30th of June 2022, items of plant and equipment which originally cost 60 million shillings were disposed of, resulting in a loss of 6 million.
40 million. 40 million.
Oh, sorry. Items of plant and equipment which originally cost 40 million
40
shillings.
million, yes.
All right, were disposed of, resulting in a loss of 6 million shillings charged in administrative expenses. Yeah, so there's no problem with the loss being charged in admin expense. What we are busy with currently is the loss only. So here, we are told that there was a loss on disposal of PPE of 6 million. So we'll take that directly and we classify it here. Loss on disposal of PPE is 6 million. 6
There's
million
no
shillings.
gain.
There's no gain, yeah, so I can do away with this.
Or you can just let it be that way and you put 0.
Oh,
Is that okay?
Okay, fine. So that I just maintain the format, eh?
Yes.
All right. What is this? Gain on disposal of PPE, that's a 0, all right. Then we have finance cost. We have finance cost. Finance cost, that one we'll pick it directly from our income statement, and it's here. 17. So this will be equals to 17. That will be 17. That will be 17. So that is everything that we need to have there. That's everything that we need to have there. Now, from here,
there's something you mentioned.
Yes.
The one you are saying that we come back and look for anything in the rows preceding profit before tax.
Exactly.
Anything apart from distribution, admin, and cost of sales.
Exactly.
But up there, I can see the investment income and
great.
gain on financial assets at fair value.
Great. So let me add some 2 spaces here. You can just highlight the 3 that you have before. That is before we get our working capital changes. So highlight these items that contribute to working capital changes: receivables, inventory, and payables. You put your cursor on the line below here. That is on the border below.
You move it down.
Exactly. Click and hold on, and then you move it down so that we have some about 2 or 3 spaces.
Okay.
So let's just do a cross-checking. So here's our profit before tax. Let me give it a yellow fill. All right. So we go up. Finance cost,
done.
We have adjusted for it. Distribution cost, we have said we don't touch on that. Admin, ignore. Investment, we have adjusted. No. Investment, we haven't adjusted.
Yes, we need to adjust.
Yeah, so we bring in investment income. We bring in investment income. Now, for these ones that you are bringing from the income statement directly, if it was added in the income statement, you subtract it here.
Yeah.
If it was subtracted, you add it.
Okay.
So it means that for our investment income, you're going to have minus
6.
6 because it was added, so we subtract it.
Okay.
So we are done with the investment income. We go to gain on financial assets at fair value. The gain on financial assets at fair value, we have not done the adjustment. It doesn't fall under distribution. It doesn't fall under admin. It doesn't fall under cost of sales. So we adjust for it. The gain on financial assets at fair value, this will be equals to, it was as well added, so you subtract it. Gross profit, this is an output of revenue and cost of sales.
Yeah.
We have cost of sales and revenue, so we are done with that.
Okay. And then you showed me how to do the bracket instead of using the negative. Can you do it again, Mala?
Yeah, we can. Just before that, let me call this cash. The cash flow, this is cash flow before working capital changes. It's going to be cash flow before working capital changes. Now, if you want to have the brackets for negatives, let's highlight the whole range now that we are going to work with other values within. So I can just highlight it up to there.
Yeah.
Then once you do that, just right click. And then you say format cells. You are there?
Yeah.
You go to custom.
Okay.
Then from custom, we'll check from whatever that we have here. We'll check from what we have here. And we should have this format here. I don't know if you can see it. Let me select
it. Very well. I can see it.
Yes, so probably yours may be having something like a minus ###0, something of a sort. So if yours is minus, you simply remove that minus and then you put the ###0 into brackets. But if it's already into brackets, just select that formatting. It will automatically adjust.
Okay.
So you select that, then you say okay.
All right.
Yeah. So the negatives are now in brackets. So we get our cash flow before working capital changes. I can simply say alt equals. It needs to include the profit before tax. So we'll get 179. So 179 is our cash flow before working capital changes. So we go and now do the working capital changes. We now go and do the working capital changes. For working capital changes, we have inventory, we have receivables, and we have payables. Here, we look at the movement. We look at the movement of these working capital items.
I'm going to ask a question.
All right.
In a situation whereby you would have amortization stroke impairment, maybe an increase with 10, assume it was a vice versa. We would have done it as we would have subtracted it.
Yeah, so if it is a gain,
yes,
being a positive, then it simply means that is a revaluation gain.
Okay.
Yes. So we don't call it amortization or impairment. We call it a revaluation gain.
Oh, okay.
Yes. Amortization is simply the reduction in value, same as impairment, the decrease in value of your intangible assets.
Okay, I get it.
All right. So for the receivables, inventory and payables, we will say that we look at their movement. Was there an increase or there was a decrease during the period? Now we start with the receivables. And if you go to our income statement, sorry, not income statement, but statement of financial position. If we check at our trade receivables, we had a movement from 87 to 95. We had a movement from 87 to 95. The question is, if we have a decrease in receivables, the question is whether that's a cash inflow or that is a cash outflow, because generally that is what we are looking at in the income statement, whether we have a cash inflow or we have a cash outflow. Now, receivables arise from sales.
Yeah.
It means that when we have a decrease in our receivables, basically,
we've collected money.
Yes, we have collected money.
Yeah.
But let me make something clear here. For this aspect of receivables, what happens is we look at it from the perspective of sales. When we have an increase in sales, we ask ourselves, well, is that a cash inflow or a cash outflow? When you have an increase in sales, it is a cash inflow, because people are bringing in money. That makes sense, eh?
Yes.
So when we have an increase in sales, we have a cash inflow. Now, the assumption is whether it is a credit sales or a cash sales, it is normally treated the same. So if we look at this, we had a movement from 87 to 95, which is an increase.
Yeah.
So it means that we had a cash, we had
More sales.
No, this is trade receivables, eh?
Yes.
So for receivables, these are debts that people owe us.
Yeah.
So when they increase, it means that we have less cash at our disposal.
True.
Yes, it means that we have less cash at our disposal. So that will be a cash outflow, which means that it is going to be in negative. So for our receivables, we are going to subtract the change, and this is going to be equals to 87
minus 95.
Yes,
It's
87
negative,
minus 95. Yeah, it comes in that order. And by the way, if you don't want to confuse yourself with this issue of minus and plus, whether you are going to subtract it or you're going to add it, simply do opening minus closing.
Okay.
Just take the opening value minus the closing value from your income statement, then everything will be okay. Otherwise, you will confuse yourselves of whether you should add it or you should subtract it. So just take the opening minus closing.
Closing.
Yeah. Then we go to inventory. For inventory, if we check, we had 176 to 123. We had 176 to 123. So it means that we reduced our inventory. We reduced our inventory, which means that we sold more. So that is a cash inflow.
Yeah. So 176 minus 123.
Exactly. 176 minus 123. We get that 53. Then we go to payables. Payables should be from the liability side. And from our payables, we have 100 to 156. We have 100 to 156, which means that we had more. Yeah, it is an increment from 100 to 156. So our liabilities increased, which means that we have a cash inflow, which means that we have a cash inflow. We have retained cash, we have not paid it. So we are going to put it as a positive. So this will be equals to, if we take opening minus closing, so we are going to have 100
Minus 156 to negative 56.
156, 100 minus 156. That is 56. These are minus 56. These are negative, but we are holding more because we have not paid cash. It's a cash inflow. It should be positive for our payables. Payables is a reverse of, creditors is a reverse of our assets. The liabilities should be a reverse of our assets. So when when assets increase, we say that we add. But when liabilities increase, we should
decrease.
Our liabilities, when they increase, we should add. We should add. So this should be equals. This should be a positive. So I can just make this a positive. I can say minus. If I say minus, will it be a true value? No. Let me say this should be 156 minus. Yeah, 156 minus 100. Yes, I get it should be a positive. Sure, that's a 56. That is 56 positive of 56. So from here, we now add everything to get our cash generated from operations. So you'll say alt equals. It should start from 179. So we add all that, and then you get 280. We add that, then we get 280. So what we add here is simply tax. The tax paid. We now add the tax paid. For the tax paid, we need to do some working. Yeah, we have 47. This is the closing.
Okay.
That is what this was our tax expense during the period, but we have tax expense. We have got the income tax liability from our statement of financial position. We had opening and closing. So for tax, we need to do some working. Normally, we don't take it directly like that. So let's do our working too for tax. We do our working too for tax. And here, we start with our balance brought down. We start with our balance brought down. And the balance brought down for tax was 34.
Yeah.
That is from the statement of financial position. The one for the year 2021. It is 34. Correct. Yeah. And then we have the tax charge for the year. Tax charge for the year. And the tax for the year, this one we get it from our income statement tax for the year. It's 47. So let me put minus 47 because this is already negative. So we'll have 47. Now, the question is, when opening, I had 34. During the year, I was to pay 47. Which means that when closing, I should have a total of when closing, I should have a total of 81, which is the opening plus the tax charge that I had during the period. So I should have a total of 81. But what did I have at the end of the period? We have the balance carried down. And our balance carried down was equals to, we look at that from our, here, we have 19. From our statement of financial position, 19.
Yes.
Now we have this decrease from 81 to 19, which means that during the period, we paid the taxes amounting to 81 minus 19.
62.
Okay. So we get here our tax paid. You said it's 62, eh?
Yeah.
So that's going to be 81 minus 19 here. Yeah, 62. So our balancing figure is what we call the tax for the year, the balancing figure. So for our tax paid, we'll say this is equals to 62. It's equal to 62. And of course, we are supposed to subtract it because that is a cash outflow. So we get our total cash from operations. That is our total cash from operations. Yeah. And I can put it here. Let me put it the other side. Yeah, I can have it there. So that's my total cash from operations. So with that, we are now done from cash from, we are done with cash from operating activities. Cash from operating activities. We go to next is cash from investing activities. Cash from investing activities. Now, cash from investing activities here, what we have said is that we look at disposal or acquisition of any long-term assets. We look at the disposal or acquisition of any long-term assets. Now, for this particular place, what we do, we go to our statement of financial position. We go to our statement of financial position, and then we look at our non-current assets part. We look at our non-current assets part. For our non-current assets part, we have got property, plant, and equipment, intangible assets, and we have financial assets through other comprehensive income. Yes. For the three, we look at, well, number one, was there a disposal? Number two, was there an acquisition? And what was the cash movement for the disposals and acquisitions? So we are going to start with property, plant, and equipment, that is PPE. Was there a disposal? Yes, I remember we had a disposal from additional information number one. Here, you are told that property, plant, and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended 30th of June 2022, items of plant and equipment which originally cost 40 million shillings were disposed of, resulting in a loss of 6 million shillings. These items had a net book value of 28 million shillings at the date of disposal. What are we interested in here? We are interested in the cash that was received upon the disposal. So we need to calculate that. We are told that these items, they had a net book value of
28 million.
Upon disposal, we made a loss of 6 million. What does that mean? We disposed at 22.
28 minus 6.
Exactly. So we do that. So for our cash from investing activities, that's what we are going to start with, and we'll have cash generated from disposal of PPE. cash generated from disposal of PPE, cash received from disposal of PPE, and this will be equals to 28 minus 6, which gives us 22, And of course, we disposed, and therefore what did we do? We received cash. So we put it as a positive. Now, for the PPE, we need to check if we had an acquisition. Are we told that there was any acquisition? No, we are not told. So what do we need to do? We need to calculate. We need to do a working and check whether we really had an acquisition or not. So that will be our working 3. That will be our working 3. So we do our working 3. And working 3 will be with respect to either acquisition. It can be acquisition or it can be a disposal of PPE. Now, we start here with our balance brought down. Balance brought down. And our balance brought down is equals to, we check for that from our statement of financial position. And for our PPE, the balance brought down is 264. We have a balance brought down of 264. Then from here, we look at what was disposed. So we had a disposal. We had a disposal during the year, and our disposal. Now, when computing for this, we are going to use the disposal at the book value. We are not necessarily looking at the cash that was generated during the disposal. Look at the disposal at the net book value. And the disposal at the net book value was 28 million. So disposal is 28. We will subtract our disposal. We'll subtract our disposal. Then we check at depreciation. We were given a depreciation of 43.
Yeah.
So we'll subtract the 43. And then, did we have any revaluation on these assets? Did we have any revaluation on these assets? And for the revaluation, we look at either it was a loss or it was a gain. Now, let's check from our balance sheet if we had any revaluation for our PPE. From our balance sheet here, revaluation for PPE, that should be under equity and capital. Yes, that is it. The revaluation reserve. So we had 67 to 36. We had 67 to 36. That means that we had a decrease in the revaluation reserve for PPE. We had a decrease in the revaluation reserve. So we also have here, so loss on revaluation. We have our loss on revaluation. This is going to be equals to 67 minus 36. This is going to be equal to 67 minus 36, and we get 31. And it was a loss, so we are supposed to subtract it. Let me reverse it. I take 36 minus 67. So we have minus 31. We have minus 31. So when we add all this, what do we get here? When we add all this, we get 162. Now, let's compare this with our balance carried down. Let's compare this with our balance carried down. And our balance carried down for PPE is equals to 327. Our balance carried down for PPE is equals to 327. Now, we are supposed to close with 162, but we are closing with 327. So that means that there was
acquisition.
Yes, there was some acquisition during the period. So here we have acquisition of PPE. Here we have acquisition of PPE, and this should be equals to 327 minus 162. We get 165. So this is what we take here for cash flow from investing activities. So this was now cash paid to acquire and because it is cash paid to acquire PPE, it's a cash outflow.
Yeah.
It's a negative, exactly. It's going to be minus 165. It's going to be minus 165. So that is because we are now doing workings on acquisition of fixed assets. Let's do the same for our, which is the other fixed asset that we have. We have the financial assets through other comprehensive income. We have financial assets through other comprehensive income. So let's check for that. So we'll have our working for. And our working for will be for the financial assets through other, let me say financial assets through OCI. That is other comprehensive income. So we look at the balance brought down. And our balance brought down for this case is
zero. It's
30. No. Financial assets through other comprehensive income 10.
Number 42, row 42.
It's a 10?
Okay.
From the non-current asset section.
Yeah.
All right. So we have 10. And then do we have revaluation gain or loss? Yeah, we have financial assets through OCI, equity reserve. We have 0 to 2. That's the revaluation gain.
Yeah.
So we have here revaluation gain, which will be equals to, it's a revaluation gain of 2. We have a revaluation gain of 2. We have a revaluation gain of 2. Here we don't have any other things like depreciation or any that was disposed that we are told, any that was acquired that we are told. So this one just ends here. So it means that at the end of the period, you're supposed to have financial assets through OCI of 12. But let's check at our balance carried down. So our balance carried down from the statement that we are given is 22. So that's an increment from 12 to 22, which means once again that we had an acquisition. So this should be 22 minus 12, which is a 10. So it means that we had again cash paid to acquire financial assets. We had cash paid to acquire financial assets. Cash paid to acquire financial assets. And the cash that was paid to acquire financial assets, it's 10. We have a 10. We have 10 as the cash paid to acquire financial assets. For the intangible assets, we've used this to compute for our impairment and amortization. So that is what we'll have for our cash from investing activities. That is what we'll have from our cash from investing activities. But we also had investment income. Hii tunachukuanga directly tunaweka hapa. The one that we adjusted for from operations, we also just take it and put it directly here. Investment income. And it should be equals to
6.
6. Okay. It should be a 6. It should be a 6. So this will give us our total cash from financing. From investing activities. This will give us our total cash from investing activities, and it will be equals to 127. $127. Yeah. Then we go to cash from financing activities. There's something that I've wrongly recorded here. Cash paid to acquire financial assets 10. It should be a negative.
A negative because it's out.
Yeah. So that leads us to 147. So that's our cash from investing activities. We now go to cash from financing activities, the very last section, cash from financing activities. So this is total cash from investing activities. Cash from financing activities. Cash from financing activities. Cash from financing activities. Now this section, this section has some workings that we'll really have to do. A lot of workings for this section. We'll have to do a lot of workings from for this section. Now, for cash received from financing activities. For this one, we go to our equity. We go to our equity section. We go to our equity section in the income statement. And we have ordinary share capital. We have ordinary share capital being the first. So for our shares, we will check whether there was an issue of shares. We will check if we had issue of shares. So we have to calculate that. We have to calculate that whether we had an issue of shares or not. So that will be our working 5. So working 5 here. And for my working 5, I'm looking at
shares.
Yeah, I'm looking at issue of shares. I'm looking at issue of shares. All right. So I will first of all start with my balance brought down. Balance brought down. And my balance brought down is equals to ordinary share capital. Is it? So we have ordinary share capital of 150. Yeah, we should add it together with the share premium. We should put it together with the share
that's
premium.
part of it, yes.
Yeah. So we are going to have 150
plus 0.
Yeah, it has no effect, but let me just say 150 plus 0. So that is my balance. brought down. It's a balance brought down of 150. And then was there anything that affected our ordinary shares? Yeah, there was such an information in additional information number 2 or 1, I guess. Yes, number 3. It says 50 million shillings of convertible loan stock was converted to 50 million shillings ordinary share capital at par during the year ended 30th of June 2022. That simply means that we increased our ordinary share capital to 50 million. Not to 50, but by 50 million. Because we converted 50 million shillings of convertible loan stock to 50 million shillings of ordinary share capital. So we are going to add that. We are going to add that conversion of loan stock of 50 million. So I can just call it loan stock here. Loan stock, and it is 50. 50. Okay. So I think that's the only information that's affecting our shares, Nothing else. So it means that we should end with 200. That is 150 plus 50, we have 200. Let's cross-check that with our balance carried down. And our balance carried down.
Well, let me have a question.
Yes.
The loan stock, you add it at what point?
Loan stock.
Which was converted to share, ordinary share.
Yes. We are adding it because here we are told that.
Is it supposed to affect opening or closing?
The loan stock that was converted to ordinary shares during the year ended 30th of June 2022.
Yes.
We add it on the opening so that we see what we are supposed to close with.
Okay.
We opened with 30, for example, and then during the period.
Like in our case, we opened with 150.
Yeah, we opened with 150, and then during the period, let's make an assumption now that this was that this one was maybe, for example, an acquisition. Just an example. Maybe we increased.
Okay, I understand.
Our ordinary share to 50. Sorry, by 50, yeah?
By 50.
So that means that we are supposed to close with 150 plus 50, which is 200.
In fact, during the year, it's okay.
Yes.
Yeah.
So we cross-check that with what we closed with.
Yeah.
So we are supposed to close with 150, but we closed with, let's see, for the ordinary share capital, we closed with 230.
260 plus 30.
Plus 30. We closed with 230 plus 30, which is 260. Which is 260. So we have
a difference of 60.
200 to 260. We have 200 to 60, which is an increase. So that means that we had an issue of new shares. We had issued some new shares. That is why our ordinary share capital increased from 200 to 260. So we'll call this issue of new shares, issue of new shares, and it should be equals to 260 minus 200. Can just say 260 minus 150 minus 50. Yeah, so that's a 60. So during the period, we had an issue of shares of 60. So that is where we start from. Now, the question is, what happens when we issue shares? When we issue shares, we get capital because the investors pay for them to acquire the shares. So we get cash. So we have cash received on issue of new shares. Cash received on issue of shares, and it should be equals to 60. It should be equals to 60. When we buy shares, we are paying. So what happens? It is a cash outflow. When we issue shares, we are being paid. So what happens? It is a cash inflow. So that is our ordinary shares. Number two, we look at dividends. Was there a dividend payment during the period? Was there a dividend payment during the period? Was there a dividend payment during the period? So that is what we are supposed to look at. That is what we are supposed to look at if we had some dividend payment. So for dividends, again, we also do another working. Never assume that there was no payment of dividend. Do a working to check.
Okay.
So our working 6 will be for dividends. Our working 6 will be for dividends paid. Working 6 will be for dividends paid. So we have our balance brought down. We have our balance brought down. And our balance brought down is equals to we use the retained profits to compute whether there was dividends paid or not. So the balance brought down for the retained profits is 91. 91. That's our balance brought down. And then we have profit for the year. We have profit for the year. And our profit for the year, this one we get it from our income statement. And profit for the year from our income statement is
67.
67 is our profit for the year. So we have a brought down of 91, and then you have a profit for the year of 67. This means we should be closing with a profit of 158.
But we closed with 121.
131, eh?
121.
Okay, so for the carry down, let's see. Yeah, 121. Carry down is 121.
So there was dividend payment.
Good. So we have 158 to 121. So any decrease in profit without any notification means that it's a payment of dividend. Yeah. So our dividend paid will be 158 minus 121. That is 37. So we have that. We have that. That is dividends paid. That is dividends paid. And this is equals to it's dividend paid. That's a cash outflow. So it should be negative
37.
Yeah, minus 37. Minus 37. So from the dividends payment, we have the convertible loan stock. We have the convertible loan stock. That one we have. Now let's check the convertible loan stock. We have 150
to 100
to 100. But remember, during the period we converted 50.
Yes.
To ordinary share capital. So here there's nothing.
Yeah.
Yeah. So we go to
current liability is about the
interest payable. Trade payables, we've dealt with it. Bank overdraft is a cash and cash equivalent. Yeah. So you go to the interest payable. Interest payable. So again, we are going to do a working there. We are going to do a working for our interest paid so that we check whether there was an interest paid during the period or not. So that's working 7. for interest paid. Working 7 for interest paid. So we have our balance brought down. Balance brought down. And our balance brought down for interest is equals to 3. We have 3 as our balance brought down. And then we have for the period, what was our interest during the period? This one, you should get it from our income statement. Yeah. The finance cost is our interest.
Yes.
We have 17 during the period. We have 17 during the period. So at the beginning, we had an interest of 3. Then during the period, we had an interest of 17. Which means we should be closing with 20.
20.
Yeah. So let's look at our balance carried down. And our balance carried down for the interest is 7. So we had 20, which we are supposed to close it, but we are closing with 7, which means we had reduced it by paying for the interest. So here we have interest paid. Interest paid, and our interest paid will be equals to, we'll have 17 plus 3 minus 7. And that is 13. That is 13. So that is what we take to the other side as interest paid. So here we'll have interest paid, which is equals to, it is paid, so it's a negative. So it's going to be minus 13. Now this is what we said, that if you classify it under operations or you classify it under financing, there's no problem. So no examiner will punish you for classifying interest under financing or under operations. So we'll have it here as 13. We'll have it here as 13. We'll have it as 13. So what do we do here now? We now get our total cash flow from financing activities. We now get our total cash flow from financing activities. Because we are done with financing activities, there's nothing more. So this will be 10. That will be 10. That will be 10. That will be 10. So once we get that, then we should now get our net cash flows. We should now get our net cash flows. So the net cash flows should be the summation of cash flows from all, from both the operations, financing and investing, which will be the sum of all these things that we have here. I guess it's starting from 218. Yeah.
218. Okay.
Yeah. So we'll have it as 81. We'll have it as 81. Then we have our cash and cash equivalents brought down. So let me push this down. So here we're going to have our cash and cash equivalents. We're going to have our cash and cash equivalents brought down. Cash and cash equivalents brought down. Cash and cash equivalents. And for our cash and cash equivalents brought down, We have to check for it. So for cash and cash equivalents, for cash and cash equivalents brought down, here we check at our non-current, sorry, not non-current, but we check at our current asset section. We check at our current asset section. Whatever you have not classified as cash from operations, what you have not classified as cash from operations from the current asset section, we take it to cash and cash equivalents. And then from the liability section, we will have the bank overdraft. And the bank overdraft is normally treated as a negative cash and cash equivalent. It's normally treated as a negative cash and cash equivalents. So we can have our working 9 for that case. Working 9 is going to be for cash. Cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. So which format do we use to do this? Let me say that here I have the cash and cash equivalents for the year 2022, and here I have cash and cash equivalents for the year 2021. Yeah. So we go to our income statement, then we check from our current asset section. From the income statement, we check from the current asset section. Inventory, that's a working capital item. Trade receivables, working capital item. So we have the two. Financial assets at fair value and cash equivalents. So I'm going to pick the two. I put them here. So we'll have here for the year 2022, for the year 2022, okay. So I have 2022 and 2021. I'm going to do the same. Cash and cash equivalents, financial assets at fair value, and cash equivalents. So I have this one being 6530. That is for financial assets at fair value. 65 and 30. So financial assets at fair value. 65. What happened now? 2021, this should be equals to 30 here. Should be equals to 30. And then for my cash and cash equivalents, 2022 will be equals to cash and cash equivalents. Cash and cash equivalents. I have 29. Then for the year 2021, it is equals to 0. So that's what I have for my cash and cash equivalents. Then finally, I've got the bank overdraft. Bank overdraft. And for my bank overdraft, this is equals to, remember bank overdraft, we've said it is treated as a negative cash equivalent. So our bank overdraft should be from the liability section. For the year 2022, we had one. Do we have anything for the year 2022 for bank overdraft? There's nothing. There's nothing. So we go to the year 2023, where we had 22. For the year 2023, we had 22. So in the year 2023, we had 22. In the year 2023, we had 22. So where was I doing the workings? Cash and cash equivalents. The year 2021, sorry, what did I do? This should be a 0 for the year 2022. And then for the year 2021, this should be, 22. How much was it? 22, eh? Oh, this one here, 22. 22. So from here, we now get the summation. So we get the summation here. So this 22 should be a negative.
Yes.
The 22 should be a negative, yeah. So we get the summation of this. We get the summation of this. If we have a negative of 0 and we have a 0, is there any difference? Let me see. Okay. And I forgot to check at something. Financial assets at fair value, it may have a revaluation.
Okay.
Financial assets at fair value may have a revaluation. Let's check from our income statement. Yeah, we have it here. Gain on financial assets at fair value of 5. We have a gain on financial assets at fair value 5. So we need to include that. So we add it to our opening. We add it to our opening, the gain on financial assets through other fair value, the gain on financial assets at fair value. So we're going to add 5 so that we close with 35. So this means that we are going to have a total of, we'll have a total of 94. Then I can autofill this. So from here, I'll simply give a top and double bottom border. So these are our financial, these are our cash and cash equivalents for the period. So cash and cash equivalents brought down will be 13. Cash and cash equivalents brought down will be 13. That will be 13, which means that the total here should be equals to 81 plus 13. And I get 94. And then I look at cash and cash equivalents. Cash and cash equivalents carry down. So they should automatically balance.
Yeah.
If you take the net cash flows we add to cash and cash equivalents brought down, it should automatically balance with the cash and cash equivalents carried down, which is as well 94. So that's fine. That is it.
So Mwalimu will share with me this one, this working, and then the previous one we did.
Oh, okay. Yeah, sure.
Yeah,
I
this
will.
was copy.
I will.
Yeah.
Yeah, I will share that. So this is the working for this, and that is what we should have.